All right. Well, we know that there has been some weakness in the U.S. dollar. And as we apply it to the Canadian dollar, generally over the last year, it has faded from around 56 cents U.S. was its peak. Now it's around 73 cents U.S. Our next guest is bearish on the trajectory of the Canadian dollar. Let's bring in Mark McCormick, Managing Director and Global Head of FX and EM Strategy at TD. Mark, thanks so much for joining us. This is a big question right now, especially as it pertains to rates, where it looks like maybe the Bank of Canada will go early or first, certainly before the U.S. Is that already priced into the Loonie, or is there more room to go down?
I think part of it's priced in. I think the fact that we have scope here for a June cut and that the market's kind of anchoring the Fed sometimes around July or September, it tells us that some of this is generally priced in. I think the dollar weakness, though, is really more about positioning. So I think when you kind of look at what's pricing for the Bank of Canada, it's probably around 50-50. And again, the Fed is expected to move with pretty decent number at least by September. So I'd say overall, this is generally not priced in terms of having any kind of major divergence between the Bank of Canada and the Fed. I think the bigger piece is kind of like what happens next after the summer, because the markets have kind of anticipated right now that the ECB, the Bank of England, the Bank of Canada, they're all going to cut before the Fed, which in itself is kind of historic and it speaks to the type of the cycle that we're in. But what's more important is kind of what happens after September, or if the Fed can't cut in September, assuming we can get a potentially bad inflation number throughout the summer.
Yeah, so what does happen? What are the variables you're looking at?
Yeah, I think the most important part is if you think about it, there's a decent story around the disinflation trajectory coming back in the U.S. I think the tricky part with markets is that there is a very important election that is basically kind of straddled right around most of the important Fed meeting calendar dates. So September, November, December, everyone knows they're not really going to do anything in November. And December will be interesting because it potentially could hinge on who wins the election. If you think about Donald Trump's platform, it's very inflationary. You're talking about corporate tax cuts, you're talking about tariffs. Those are things that would add fuel to the inflation fire if inflation's running hot for the summer. So I think what we're thinking about is the asymmetric nature of the market and the way that it kind of can trade these events is that there is zero room for error on surprises. So you've got 4 CPI prints up until the September release or the September Fed date, and any upside surprise is something that can basically price out that September move very quickly for the markets. And so I don't think you're going to see the same type of surprises from the Bank of Canada, the ECB, or the Bank of England. They're all basically prepared to cut 2 to 3 times this year. And the Fed is the one that can go twice or they can go none. And then have to maybe talk about a hiking narrative next year.
So let's talk about how that plays out. Let's say, Bank of Canada cuts, Bank of England, ECB, we get 1 or 2 cuts, and then it looks like the U.S. can't cut at all. The dollar index, the trade-weighted index, how much higher does it go?
Well, that's the interesting part. That's kind of the asymmetrical view we have around this is that the dollar can strengthen quite aggressively, especially in that backdrop. I think what happens is you start to see a negative feedback loop kind of surfacing through that, because what's happening is, one, there's something wrong and something's gone wrong with the U.S. inflation story, which means if the Fed can't cut in September, again, I think December really it becomes kind of a moot point whether they can go in December, because it's all going to hinge on who wins the election. So assuming if they can't go in September, you can still get, I think, 3 cuts from each of those central banks that you just mentioned. So then you have to price in a kind of a rapid change in rate differentials. And rate differentials tends to work much better for currencies when it's driven more by inflation than by growth. So that's another thing is the U.S. has a very strong leadership across G10 currencies in particular around the trends and the strength of the inflation data, which we don't see is matched by a lot of these other countries. So I think a big piece of it is we can see a pretty significant move in FX. And the other thing we will have to price in is the risks around geopolitical uncertainty, the risk that if the dollar gets stronger and U.S. inflation starts to tighten, we're going to see global growth downgrades for 2025. So that's basically more of a risk-off environment that favors the dollar on safe haven. And then you also have that FX volatility is extremely cheap to geopolitical uncertainty that we track, and also inflation and other macro indicators. So we're also in an environment where the market's just not as volatile as it should be. And if you basically unleash a lot of these conditions through the fall, this is something that could see the dollar rally 3 to 4%. In a broad measure, whether it's the DXY or the Bloomberg DXY, which includes some emerging markets. So that's something that we can see where dollar CAD kind of starts to rally quite significantly, and euro starts to push itself back towards parity, or at least below the 105 levels that we've seen recently.
I mean, this rally would rise in the U.S. dollar would have so many far-reaching consequences. To your point, you might see global growth downgrades, emerging markets, which have recently been hot. They might struggle because the debt is denominated in U.S. I know you're not a commodity strategist, but gold and all these commodities have rallied, and in part, you could argue that a softer U.S. dollar helps that.
Absolutely. The softer dollar is reflationary. There's no doubt about it. I think a piece of it, too, that links with what our commodity strategists talk about, because we work very closely with them. The thing that you think about in FX, it's called a terms of trade factor. So it's basically countries that import commodities lose when commodities go up, and countries that export commodities win when commodities go up. So the interesting thing about emerging markets is they've been offered a very nice buffer for the last couple of years, because a lot of the countries that export that aren't in Asia, maybe besides Indonesia, they are commodity-based exporters. So LATAM has done very well through a cycle where we saw very aggressive Fed hikes and we saw very aggressive tightening of financial conditions the last couple of years, largely, again, because the transfer of wealth from the G10 importing and the Asian importing countries like Korea, Japan, Europe, they're basically sending capital into the pockets of the countries that are exporting a lot of these commodities. And what you're seeing, particularly on the gold side, is there's just more trading happening amongst emerging markets led by China, not denominating these transactions in dollars. So, the interesting part, this feeds into the discussion that I think many people will have next year, depending on who wins the election, is the impact of the broad dollar and kind of the global reserve, the dollar reserve status, because it's very clear that gold is sending us a signal that there's something happening in the market where people are not settling in dollars, and gold is a nice conduit between the old fiat world and the new digital world that a lot of people are interested in.
So let's stick with this train of thought. Assume the U.S. dollar continues to advance. Does it continue to triumph over the yen?
The yen, I think, is going to be one of the more interesting ones, because this is very idiosyncratic. Obviously, we're talking about rate cuts and whether or not central banks can cut. The BOJ is kind of the lone central bank that's kind of left on its own that has essentially a ton of runway to tighten monetary policy. We think they're going to be much more aggressive. I think a big piece of the second half of this year, whether or not it's China, Korea, Japan, a lot of countries we will talk about, we're going to be talking about their currencies, we're going to be talking about whether or not they're undervalued, and we're going to be talking about tariffs. So the interesting part is it's a two-pronged approach. One for the BOJ is that there is a massive cost of living shock, which has made itself into the BOJ minutes from the last meeting, that the cost of living shock is creating negative real income growth for Japanese consumers. And it's not probably much of a surprise that the approval ratings for the Diet and the cabinet is at the lowest level we've seen, which dovetails and correlates precisely with the undervaluation in the yen. The other side of it is that the BOJ can be hawkish to allow themselves to maybe potentially keep Japan out of the sights of tariffs. If we're talking about how undervalued the yen is, our models have longer term fair value in dollar yen under 120, and currently we're trading around 152, 150. So there it is, the cheapest currency that we track. So there's also an element here that the BOJ can kind of get ahead of the market, can be turned more hawkish, can raise interest rates, can continue with further quantitative tightening, all in a space to help rejigger the FX markets around a little bit so the yen can get stronger and then reduce the political pressures that we might see throughout the election in the second half of the year when we're talking about tariffs and geopolitics and stuff like that.